The Kenyan economy grew by 6.2% in the second quarter of this year, driven by rebound of tourism and better performance of agriculture. However, other sectors such as construction and manufacturing grew at a much slower pace. Take a look. Kenya registered improved economic growth in the second quarter of 2016. The economy expanded by 6.2%, up from 5.9% registered over the same period in 2015, according to the Kenya National Bureau of Statistics. The growth was supported by improved performance of agriculture, which expanded by 5.5%, transport, whose growth is attributable to low oil prices, and the tourism sector, which made a comeback with a 15.3% growth.
Looking at those GDP numbers, I felt, according to me, they were too aggressive. They were quite aggressive. I mean, my expectations were slightly lower based on the kind of economy we've been operating in. Those numbers came slightly higher than my expectations, and I felt they were quite aggressive. Yes, it's true, we have had a very stable economy. The growth has been quite robust.
In particular, it showed tourism recover, which is something that has been of concern. And we had heard in the past couple of months that business tourism in particular picked up in the first half of the year. So we're very encouraged by those growth numbers. You've put it correctly that in the context of a continent that is seeing much slower growth, I think the slowest in 2 decades, it is a positive story to tell.
However, some sectors registered reduced activity. Among these are manufacturing, which expanded by 3.2% compared to 5.1% in 2015, while construction decelerated to 8.2% from 11.2% in the period under review.
If I look at the first quarter, we had agriculture did pretty well. We had sectors like construction as well performed pretty well, the transport sector. The underperformer, probably the biggest underperforming sector, has been manufacturing, something we've spoken about. We expect to see similar dynamics in the second half of the year in terms of performance. However, you should start to see some slowdown in sectors that are probably more exposed to the slowdown in credit growth. Construction, a lot of it has been driven by the public sector, but any private sector construction activity may be impacted, and you could see some softer growth there, possibly around telecoms and so on. But this is really a moderation and not growth falling off entirely.
The slowdown of these sectors, coupled with the sluggish growth of credit to the private sector, has prompted the International Monetary Fund to indicate that it will review Kenya's growth expectations for 2016 downwards from an earlier forecast of 6%. In a September meeting, the Monetary Policy Committee of the Central Bank of Kenya noted a persistent decline in private sector credit and observed that the trend poses a risk to economic growth. As a result, the committee reviewed the central bank rate from 10.5% to 10%.
We did speak with the IMF, and they have suggested that they may be revising down their growth forecast for this year from 6% initially to maybe closer to 5%. The reason for that is because they're seeing some weakness in the second half of the year. Part of that relates to the fact that we have seen credit growth slow. As we mentioned, it is already in the single digits, and that's even before the rate cap was announced in August. Would suggest that we should see further weakness on the credit growth side. So the inference from that is that we should see weaker growth in the second half of the year compared to the first half of the year. But being between 5 and 6% is still pretty solid growth given what's happening elsewhere in the continent.
Credit growth has been a big part of what's driven the Kenyan economy. Maybe in the long run it's for the best. I mean, maybe it's the best that you have less credit growth to consumers. Maybe that leaves more money for investment into infrastructure, and actually maybe that could be good for Kenya in the very long run. But it could be disruptive to the growth outlook over the next year or so. It's going to be interesting to see the data.
On the macroeconomic front, Kenya continues to enjoy a stable exchange rate, with the shilling strengthening by 0.9% against the US dollar year to date. However, analysts insist that the Kenyan currency is still overvalued, even though they don't quite agree on the margin.
In Kenya's case is that fair value would be 20%, just 20% weaker from where we are today. The stability of the currency, which has been commendable, is largely due to the fact that they were able to build up stronger FX reserves buffer. Monetary policy has been firm, so it's one of the few countries in the region which has positive real rates. and they have that insurance facility from the IMF of $1.5 billion, which is a show of confidence, and particularly to investors, that if anything was to go wrong on the balance of payment side, they have access to those that facility in order to support the currency.
Our currency is slightly overvalued, but I still don't agree with the numbers they gave us. At 119, I think we are too high. And yes, the economy already supports a very stable currency. We're already experiencing, we've had a very stable forex environment. The CBK interventions have actually contributed in a big way to actually stabilizing the currency. So if at all we were way overvalued, I still believe that our trading partners wouldn't have the confidence to actually trade with us and to actually help us register the high exports that we have recorded in the market.
Kenya's not been competitive in terms of manufacturing because of the strength of the currency over a number of years. And when we've looked at the strength of the currency, what struck me about it is it really kicked in at about 2007, 2006-07. From that point onwards, suddenly the Kenyan shilling becomes really strong and stays strong relative to every other. Relative to many other currencies. And I think that's part of the Africa rising narrative, but this World Bank report from a few months ago did imply that the strength of the currency had held back manufacturing.
The inflation rate has also remained within government target of 2.5 and 7.5%. Of concern, however, is the level of public debt, which rose by 30.62% to 3.62 trillion shillings in June, from 2.83 trillion shillings a year earlier, according to the central bank. This means that the country's debt to GDP ratio now stands at 55%, and economists at Renaissance Capital say that this will negatively affect Kenya's attractiveness in the international debt market.
I think things should happen in cycles. So we've been through quite a few years of a ramp up in spending for various projects, excuse me, that you're aware of. And in order to sustain the, or to ensure that those deficits are sustainable, I think they're at the point where they need to slow down in terms of the spending before they start ramping up once again. So I think they're at that stage where they should be slowing the amount of external financing that they are getting. I think it's for that reason that if they do issue a Eurobond, it won't be of the size we saw a couple of years ago, around $2 billion. It should be smaller, maybe $500 million to $1 billion. The need is there, but I think given the cycle in terms of the fiscal spend, they're at a point where I think the authorities agree with the IMF, they need to slow the spending to ensure that the debt metrics remain sustainable.
If you look at the amount of redemptions that are lying in the market right now, our domestic borrowing may not be able to sustain both redemptions for the maturities and also the budgetary support. So I still feel that there's a high advantage or a high chance of actually the government doing this fiscal consolidation. Again, though they have already raised issues that they may not want to consider an external borrowing at the moment, but I think in the domestic market, the government is still going to remain very active.
Nonetheless, Kenya's economic growth prospects for 2016 remain well above the sub-Saharan Africa average. According to the World Bank, sub-Saharan Africa growth will slow down to 1.6% this year from 3% in 2015 before rebounding in the near to medium term.
It's a reflection on the type of growth model, the fact that we have more diversified economies in East Africa, that they're not dependent on a single commodity has helped. Yeah, that's why we're seeing the positive growth numbers we have seen. On the inflation front, I think it's actually been a very positive period. It's been a while since we've seen double-digit inflation in Kenya, which is a good thing. Inflation remains within the target region of 2.5 to 7.5%. When we met the central bank, they expected it to slow even further through to December, and I think particularly in December because of the base effect from the excise tax that was imposed a year ago.
There was a period of very high volatility in the market. We saw commodity prices actually coming down very fast. But if you remember last year, and that actually even actually caused some pressures on most of the SSA currencies. We saw the kwacha, Zambia kwacha actually flop. We saw many other currencies that were affected, the Nigerian naira, Ghana cedi. There was a lot of effect on the market on the currencies. But if you remember, Kenyan currency was not very affected as compared to other currencies. Now, again, looking at this year, if you're talking of sub-Saharan being at around 1.8%, actually they have downgraded it from 3%, and that actually leaves us Kenya with a better chance of actually recording better growth across sub-Saharan. And I think I would mainly attribute now this star performance to actually the fact that Kenya is not commodity reliant as compared to some of these other SSA countries that have we have been looking at. Kenya has remained relatively stable. We have had our tea earnings. I mean, our economy is performing relatively well as compared, because if you're to look at the end of till the end of the year, we are looking at a GDP growth of between around 5.5 to 5.7 overall, and I think this is going to be very to actually come higher than where the sub-Saharan is going to be playing at.